Yeah, so Blackstone, KKR, Carlyle, they're down because of private credit and the concerns around private credit. And when you look under the hoods of a lot of these private credit funds, what you'll find is around 20, 25%, even more sometimes, have exposure to software. And
Hmm.
obviously with Anthropic and the announcement of their coding system, there's this belief that Anthropic has the tools now where you can develop your own software application and you don't need to hire Salesforce as an example. So if a lot of these private credit companies have these exposures to these software SaaS companies, that's where the concern is in terms of investors. So it's kind of sell today and it's like going to trial and being guilty before you even go through a fair trial. And that's really what's going on right now. And the market may be right, by the way, because I think private credit has been basically the Wild Wild West. And, since
That's right.
2008, 2009, when banks really haven't been involved in lending as much because of different regulations, private equity companies took over this space and really built up a substantial amount of money. But relatively speaking, it's not a huge amount. I think it's like a couple $1 trillion, $1.5 trillion in total in private credit. I don't know. I think it's probably somewhere in the middle. I don't think it's as bad as the market's saying. I don't think it's as shallow as other people think. I think it's probably somewhere in the middle, and that's why these particular stocks are down.